$3,250 a month after federal tax. That is what a $1 million retirement account actually deposits for a 65-year-old couple in 2026. And that balance puts them in the top 9.2% of every household aged 55 to 64 in this country. 9.2%. Not the top half, not the top quarter. The top one household in 11. Hold both of those numbers next to each other for a second, because they do not feel like they belong to the same family. The rank sounds enormous. The check sounds like a decent pension from a mid-sized employer. And the strangest part of that check is that the federal government takes nothing from it. Zero. Not a reduced rate, not a favorable bracket, nothing. That will stop being true exactly one rung higher up this ladder. And when it stops being true, the whole shape of the thing bends. So we are going to climb it. $500,000, 1 million, 2 million, and the floor underneath all three. Because the ladder runs downward much further than most people looking up it realize. The million is the number everyone in your age band quotes at each other. It got that job because it is round and has 7 digits, not because anything about your life changes at it. What changes your life is the monthly deposit. And the monthly deposit is set by 3 things that have almost nothing to do with reaching a round number. Before we climb, we have to find the bottom, because you cannot know your rank without knowing what you are ranking against. On February 26, 2025, the Congressional Research Service published its analysis of the Federal Reserve's most recent survey of consumer finances. And it broke households down by the reference person's age and by what sits inside their retirement accounts, defined contribution plans, and individual retirement accounts. The 401k and the IRA for households aged 55 to 64 people in the last decade before the decision, people who have had 30 or 40 working years to accumulate something, about 40.6% hold no retirement account at all. Not a small one, none. Another 30% hold something above zero and up to $100,000. Add those together. 70.6% of the households in your exact age band are sitting at $100,000 of retirement assets or less. That is not a doomed statistic, and I am not going to use it as one, because that number does something specific to you. It means your rank has already moved before you have saved another dollar. The threshold you are trying to reach, you may have crossed a while ago without noticing, because you were measuring yourself against the people in your neighborhood who look comfortable rather than against the actual distribution. Now turn that bottom block into cash, because a population share does not pay for anything. $100,000 converted at the withdrawal rate we will get to in a moment produces $3,900 a year, $325 a month. Written next to the $3,250 from the top rung, it looks like a punchline. 10 times the balance, 10 times the check, and the gap between 2 Tuesdays that could not possibly resemble each other. Except that $325 a month is not what that household lives on, and it is nowhere close. That is the portfolio's contribution and nothing else. And by the end of this, we are going to come back to that same household and put a real number on its month. It moves more than you think. Keep 325 in your head as an incomplete figure. That is also the first place the arithmetic starts contradicting the mood. Because the same data set that produces the 70% block also produces an average retirement balance for 55 to 64-year-olds of more than $537,000 against a median that sits at $185,000 among households that own an account at all. I have spent 10 plus years running my own business, surrounded by accountants and fiscal lawyers who taught me how money actually moves. And I have multiple hundreds of thousands of dollars invested, so I read the boring documents for sport. And the thing that reading them teaches you is that an average and a median are not 2 versions of the same fact. They're 2 different quantities wearing the same hat. The average is dragged upward by a thin sliver of very large accounts. The median tells you about the middle household. Headline writers print the average because $537,000 is a more alarming sentence than $185,000, and almost everyone who reads it walks away misranked. That gap between the number that scares you and the number that pays you is the entire subject here. It is also why I built a digital book called The Exit Code. The piece of it that matters for this conversation is the part that turns a balance into a specific date rather than a specific feeling. It is linked in the description. And if this is the kind of arithmetic you want more of, subscribing is free and it helps. Back to the ladder. We need one more reference line before the first rung, and I'm going to state it and then deliberately leave it hanging, because it decides which rung actually matters. The Bureau of Labor Statistics reported average annual expenditures of $78,535 per consumer unit in 2024. That is every American household at every life stage, working and retired, mortgaged, and paid off. It is not a retirement target, and I am not going to pretend it is. But it is the closest thing we have to a horizontal line drawn across the whole ladder, the spending of an ordinary American household. Watch which rung's portfolio clears that line on its own. The answer is going to be later and tighter than the balances suggest. The tool that turns a balance into a check is the withdrawal rate. And here I am using Morningstar's work, which for someone retiring in 2026 puts the safe starting rate at 3.9%. That is up from 3.7% the year before, because capital market assumptions improved. It assumes a portfolio holding somewhere between 30 and 50% in stocks with the rest in bonds and cash, and it is calibrated to give you a 90% probability of still having money left after 30 years of inflation-adjusted spending. 30 years. Hold on to that word, because it is doing quiet work and it changes later in a way that costs real money. That is the entire mechanism. The rank tells you where your balance sits in the band. The balance times the rate gives you a gross annual withdrawal. The deduction stack decides what the government leaves you. And what the government leaves you divided by 12 is what Tuesday looks like. Everything else in retirement commentary is decoration on top of that chain. So the first rung, $500,000 of retirement assets. Go back to the distribution. 40.6% with nothing, 30% up to 100,000, and 15.5% holding more than 100,000 and up to 500,000. Stack those three blocks and everything underneath $500,000 in this age band is accounted for, which means $500,000, the number that gets treated online as the sad, not quite there balance. The one people apologize for in comment sections clears about 86% of the households in your age band. You are not behind the pack at 500,000. You are in the top one household in 7. I want to be careful about what that rank does and does not mean, because a percentile is a comparison, not a verdict. Being ahead of 86% of your age band does not mean the money is sufficient for your particular life in your particular city. It means the anxiety you feel about the balance is not calibrated to the population. It is calibrated to a headline average and to whatever your brother-in-law implied at Thanksgiving. Now convert it. $500,000 at 3.9% is $19,500 a year of gross withdrawal. Now, the 2026 tax rules decide how much of that $19,500 the couple keeps, and the answer runs through 3 deductions that sit on top of each other. For a married couple filing jointly, the standard deduction this year is $32,200. If both spouses are 65 or older, each gets an additional standard deduction of $1,650, which is $3,300 more. And on top of that, the senior deduction created in 2025 gives each person 65 or older another $6,000, available through 2028 with no phase out until joint income above $150,000. Stack them. And those 3 pieces come to $47,500 of income that a 65 plus couple can receive before the federal government taxes a single dollar of it. $19,500 is not close to $47,500, so the entire withdrawal lands untaxed. $1,625 a month, and the tax bill is 0, at which point the arithmetic looks obvious. Double the balance, double the check. If $500,000 pays $1,625, $1 million pays $3,250, and this ladder is a straight line. Hold that thought, because the population underneath it is about to behave very strangely. Between $500,000 and $1 million of retirement assets, in the entire 55 to 64 age band sits 4.7% of households. 4.7, read that as what it is. The middle of this ladder is nearly empty. The second $500,000, the one that takes most people an additional decade of saving, of maxing the contribution, of turning down the trip, of working the year they did not want to work, moves you from about the 86th percentile to about the 91st 5 percentile points for $500,000. That is the first real crack in the story you clicked with. Rank is not something you can buy in a straight line because the population does not stand in an even queue. It bunches at the bottom, thins out savagely in the middle, and stops. Then the top of the band. 9.2% of households aged 55 to 64 hold more than $1 million in retirement accounts. And that is the highest rate of any age group in the country. Not people in their 70s who have been drawing down, not people in their 40s. You are looking at the exact decade of American life where retirement wealth peaks. $1 million at 3.9% is $39,000 a year. $39,000 is still underneath the $47,500 deduction stack. So the federal tax is again zero, and the monthly deposit is $3,250. That is the figure from the opening, and now you know exactly where every piece of it came from, which means the prediction held. Twice the balance, twice the check. Rung 1 and rung 2 are honest with each other, and if the latter behaved this way forever, none of this would be worth your afternoon. That is the last rung where it is true. From here, the two ratios start pulling apart, the balance ratio stays fixed and large, the check ratio keeps coming in smaller, and the reason it happens is sitting in the deduction stack we walked through 2 minutes ago. Before we find out where it breaks, we have to deal with a ruler problem, because there is a very good chance the percentile you have already looked up for yourself is not the one we have been using. Most people who go looking for their rank find household net worth, not retirement assets. In the same Federal Reserve survey, households aged 55 to 64 had a median net worth of $364,270 and an average of about $1,564,000. Net worth includes home equity, vehicles, business interests, everything you own minus everything you owe. And on that ruler, a $500,000 nest egg does not look like the top 14% of anything. It looks ordinary. Which is why so many people in your position come away from a percentile lookup feeling worse than they went in. Both rulers are real. Only one of them writes you a check. Your home equity is a number that sits on a page, it can lower your monthly costs enormously, and it can be converted through a sale or a loan, but it does not deposit anything on the first of the month while you are living in it. So from this point forward, we are not ranking assets anymore. We are ranking months. Every figure from here is a monthly after-tax dollar, which is what the last 12 minutes have quietly been doing already. And now you know why. Rung 3, $2 million. Start with a rank, and notice that there is nothing left to buy. Above 1 million, the data stops naming blocks. The top 9.2% is the last name group in the distribution. So $2 million, $4 million, $7 million, all sit inside the same top slice. You cannot climb a rung that does not exist. Rank saturates long before money does. $2 million at 3.9% is $78,000 a year. Look back at the line we drew and left hanging. $78,535, the average American household's annual spending. A $2 million retirement portfolio, drawing at a rate designed to survive 30 years, produces $78,000. It does not clear the line. It comes up $535 short of it, before a single dollar of tax, before Social Security, before anything. $2 million. The number that makes people in this age band feel wealthy. On its own, it funds the spending of an average American household, and it misses by a rounding error. And now the deduction stack finally breaks. $78,000 of withdrawal minus $47,500 of stacked deductions leaves $30,500 of taxable income. The joint 10% bracket runs to $24,800, which costs $2,480. And the remaining $5,700 is taxed at 12%, another $684. $3,164 to the federal government. The first federal tax bill on this entire ladder, $6,236 a month. Now, audit the two ratios you have been tracking without being told to. Rung 3's balance is 4 times Rung 1's balance. Rung 3's monthly check is about 3.8 times Rung 1's monthly check. That is a small divergence, but it is the first one. It is caused entirely by the tax code, and it only widens from here. 4 times 1,625 a month would be 6,500. The actual check is 6,236. And the missing $264 a month is that $3,164 tax bill divided by 12, which is what the deduction stack looks like the moment it runs out. There is a lever in this that is not the balance at all, and it is worth more than the second $500,000. Remember, the 30 years attached to the 3.9% rate. Take the same $1 million, unchanged, not a dollar different, and put it in the hands of a couple who are 60 rather than 65. Two things change immediately. The horizon stretches to 35 years, which pulls the safe starting rate down to about 3.5%. And they are not 65, so no age add-on and no senior deduction. Their stack is the plain $32,200 standard deduction and nothing else. $35,000 of gross withdrawal, $2,800 of it taxable, $280 of federal tax, and about $2,893 a month. Identical balance, identical portfolio, $357 a month apart, purely because of a number on a birth certificate. The check is not a property of the balance. It is a property of the balance, the horizon, and the calendar. And 2 of those 3 are things you can move without saving another dollar. Which brings up the largest input on the whole board, and it is not your portfolio. The claiming decision is a permanent multiplier on a stream you have already paid for. For someone whose full retirement age is 67, claiming at 62 cuts the monthly benefit by about 30% permanently, and that reduction does not heal. Waiting past full retirement age earns delayed retirement credits of about 8% a year up to 70, which is a 24% increase over the full retirement age amount. No product involved, nothing to buy, no salesperson in the room. It is arithmetic on a benefit you already earned, and the spread between the worst version and the best version of it is larger than what the second $500,000 of portfolio did to your rank. Here is the part of the standard advice that is aged badly. The dominant retirement message for 30 years has been maximize the balance, hit the number, retire at 65. Balance, balance, balance. And there is a reason that message circulates. And it is not a conspiracy, and it is not bad faith. An advisor who charges 1% of assets under management is paid on the balance, not on your monthly after-tax deposit on the number in the account. A fund company is paid on assets. A retirement calculator is built to produce a green line at the end of an accumulation graph, because that is what makes people open an account. Every intermediary in the chain is compensated on the numerator, and none of them is compensated on the check. So the industry optimizes what it is paid to optimize, and the advice you get is honest and competent and pointed at a slightly different target than the one you care about. Knowing which number ranks you and building a system around the number that pays you are 2 very different problems. And the second one is why I built the exit code. It takes 50 years of actual retirement data and turns it into a mathematical framework for exiting the rat race, rather than a percentage you are supposed to trust forever. The part that connects directly to what we have been doing is the 4% trap and the dynamic withdrawal method that replaces it, because a fixed inflation-adjusted withdrawal treats a strong market and a bad one as if they deserve identical behavior, and your deduction stack is not fixed either. It also lays out the 58% rule and the buffer you need against a forced exit, which matters more in this exact age band than at any other point in life, because most people who retired earlier than planned did not choose the date. 8 chapters of research, no filler. It costs less than a dinner out through the link in the description. Every year you spend optimizing the wrong number compounds against you. Now, let me put the biggest piece of the month back on the table, because everything we have calculated so far has been the portfolio alone. The average retired worker's benefit in 2026 is about $2,080 a month. After the 2.8% cost of living adjustment took it from roughly 2015 at the start of the year, take a couple with one average earner's check plus a spousal benefit at half of it, and you are at about $3,120 a month combined. Set that next to the floor household we left unfinished. $325 a month from a $100,000 portfolio. $3,120 a month from Social Security. The benefit is roughly 10 times the portfolio for the household in the bottom 70% of the age band. And it is nearly flat across the entire band because it is calculated from wages, not from savings. So run the floor household again, properly this time. $3,900 of withdrawal plus $37,440 of benefits. Their provisional income, the withdrawal plus half the benefits, is about $22,600, which is under the $32,000 joint threshold where benefits start becoming taxable. That threshold has not moved since 1993, and this household still sits comfortably beneath it. So none of the benefit is taxable. The withdrawal disappears into the deduction stack, and the federal tax is zero, roughly $3,445 a month, not $325. The floor of this ladder is more than 10 times higher than the portfolio math alone suggested. And the reason is that the portfolio was never the floor. Social Security was. Now do the same thing at the top of the band and watch what happens. The $1 million household adds the same $3,120 a month of benefit to its $3,250. But now the stacking triggers what the floor household avoided. $39,000 of withdrawal plus half the benefits puts provisional income near $58,000, well above the $44,000 upper threshold. So a chunk of the benefit becomes taxable income, about $17,700 of it. Taxable income lands near $9,000 after the deduction stack, and the federal tax comes to roughly $900 for the year, roughly $6,300 a month. There is the collapse. 10 times the retirement balance. $100,000 against $1 million. A household in the bottom 70% of the age band against a household in the top 9.2%. And the gap in what actually arrives every month is under 2 times. Not 10 times, not 5, under 2. And it happens for 2 reasons, neither of which your balance controls. Underneath every household in this band, there's a benefit floor that is nearly flat, because it was calculated from a working life rather than from a savings rate, and that floor lifts the bottom of the ladder violently. Above every household, there is a deduction stack that makes the first $47,500 free and then starts charging. And that charge climbs as the balance climbs, and it drags the top of the ladder down. Lift the bottom, tax the top, and a 10-to-1 spread in assets compresses into a 2-to-1 spread in monthly income, which means the reflex that got you here is the one that now works against you. For 30 years, your job was accumulator. Maximize the balance. Defer the gratification. Treat every dollar spent as a dollar of failure. And it worked, which is exactly why it is hard to put down. But the job title changed somewhere in the last few years without an announcement. And the new one is cashflow manager. The accumulator asks what the balance is. The cashflow manager asks what the deposit is after tax, and whether the horizon and the claiming date are set to maximize it. Staying in the old role has a price, and now you can see it in dollars. Another $200,000 of balance at 3.9% adds $7,800 a year of gross withdrawal. And if you are already above the deduction stack, a piece of that goes straight back out in tax and can pull more of your benefit into the taxable column with it. Whereas moving your claiming decision from 62 to full retirement age hands back the whole 30% that early claiming cuts off, measured against the same full retirement age benefit, on a payment that is already the largest line in your month, permanently, for the rest of 2 lives. And it costs you nothing but sequencing. That is the trade, and it is not a close one. Lazy investing built more fortune than crypto memes, and lazy in this context means letting the deduction stack and the benefit formula do the work while you stop grinding the numerator. So, 1 clean pass down the ladder, 2026 rules, a 65+ couple, all withdrawals from tax-deferred accounts, and the population data from the Federal Reserve's 2022 survey, which is the most recent complete one. The next wave lands later this year. $100,000 puts you above the roughly 40% of your age band, with nothing at all, and pays $325 a month from the portfolio, or about $3,445 with the benefit untaxed. $500,000 clears about 86% of households your age and pays $1,625 a month untaxed. $1 million is the top 9.2% and pays $3,250. Untaxed alone, roughly $6,300 once the benefit stacks and the tax starts. $2 million buys no additional rank whatsoever and pays $6,236 from the portfolio, with the first federal tax bill on the ladder attached to it. The number that ranks you is a balance fact. The number that pays you is a cash flow fact, and they answer different questions. Inside this age band, your horizon and your claiming date move the monthly check more than the next $200,000 of balance does, because they change the rate and the deduction stack, and the balance only changes the numerator. One last thing, and it is the smallest ask on the internet. Clicking subscribe genuinely helps this channel, so thanks to everyone who does. If you want more of this, the boring documents, read properly, translated into what actually lands in your account, that is what lives here. Go look up which side of $47,500 your withdrawal falls on. That single line decides more about your Tuesday than the percentile ever will. Even $1,500 your withdrawal falls on, that single line decides more about your Tuesday than the percentile ever will.